Imagine waking up in a world where money seems endless. Banks are calling you, not the other way around. Interest rates are low, credit is cheap, and global lenders say the same reassuring phrase again and again: take more, take more, take more. Now imagine that this same world flips almost overnight. Interest rates shoot up like a rocket. The global economy tightens like a fist closing shut. And suddenly, the same lenders who once begged you to borrow are demanding their money back. You look into your accounts and realize the truth: there is no money left. This is not a story of a single country or a single mistake. It is the story of nearly an entire continent of nations that believed they were stepping into a golden future, only to find themselves tumbling into one of the greatest financial crises of the 20th century. And the mystery at the heart of it all is this: how did so many governments, economists, and global institutions fail to see the catastrophe coming when the warning signs were right in front of them? To unravel this, we have to pull the camera back to a time when the global financial system itself was shifting beneath everyone's feet. In the late 1960s and early 1970s, the world was undergoing a monetary transformation. The old Bretton Woods system, which had anchored global currencies to the United States dollar and the dollar to gold, began to crack. Speculation spiked. Confidence eroded. By the early 1970s, the United States abandoned gold convertibility. Currencies floated freely, and the global financial order entered uncharted territory. Oil prices then erupted after the first oil shock, sending waves of profit into the hands of petroleum-exporting nations. These countries, especially in the Middle East, suddenly held immense surpluses of petrodollars, surpluses so large that banks in the United States and Europe scrambled to recycle them into loans. They needed borrowers. They needed demand. And they found it in Latin America. At the time, Latin American nations looked like promising bets. Many had ambitious development plans, expanding industries, and youthful populations. They were eager to grow, eager to modernize, eager to transform their economies into global players. The international banks, flush with petrodollars, saw a perfect match. They began lending at a scale previously unimaginable. Governments in the region took the loans enthusiastically, often believing that rapid economic expansion would make repayment easy. After all, global interest rates were low, commodity prices were rising, and the idea of a worldwide downturn felt unthinkable. Growth was the magic word, the mantra repeated in every ministry, every multilateral meeting, every bank office. And so the borrowing accelerated. But beneath the surface, something fragile was forming. Countries like Brazil, Mexico, Argentina, and others were piling on external debt faster than their economies could structurally handle. Much of the borrowed money went not into productive long-term infrastructure or diversified industry, but into short-term programs, prestige projects, or the desperate plugging of budget deficits. Private bankers, earning enormous fees, did not question the sustainability. Governments, pressured by politics, did not slow down. And the global financial environment, which looked so friendly, was about to turn hostile. The turning point began quietly. In the United States, inflation was rising rapidly. To fight it, the Federal Reserve tightened monetary policy under leaders like Paul Volcker. Interest rates climbed higher and higher until they stood at levels not seen in modern history. With these higher rates, something catastrophic happened. The cost of Latin America's external debt ballooned overnight. What had once been manageable suddenly became crushing. But that was only the first blow. The second blow came from global demand collapsing, pushing down commodity prices. The third blow was capital flight, as investors pulled money from emerging markets, seeking safer returns in American assets. Then came the moment when the crisis surfaced for the world to see. In the summer of the early 1980s, Mexico announced that it could no longer meet its debt obligations. That declaration was like a match dropped into a field of dry grass. Investors panicked. Banks panicked. Governments panicked. If Mexico, one of the largest borrowers in the developing world, could not repay, what about the others? Contagion spread rapidly. Brazil struggled next. Argentina followed. Then Chile, Peru, Bolivia, and beyond. One by one, the dominoes fell. A regional debt crisis became a global financial emergency. It was not only Latin America at risk. The entire international banking system suddenly felt exposed. International lenders and institutions scrambled to respond. The International Monetary Fund stepped in with emergency programs. But these programs came with strict conditions. Countries were required to impose austerity measures, cut spending, devalue currencies, remove subsidies, and open their markets. These policies were intended to restore balance and discipline, but the social cost was immense. Unemployment soared. Inflation spiraled in some nations to levels previously unimaginable. Living standards collapsed, and resentment grew, as citizens felt they were paying the price for decisions they never made. As austerity deepened and currencies weakened, the crisis revealed a painful truth. The original loans had not built the kind of economic resilience needed to withstand shocks. In many cases, the money had flowed into consumption rather than production, into political spending rather than structural reform. Governments faced a harsh dilemma. Should they continue cutting deeply to satisfy creditors, risking social unrest? Or should they resist, risking default and isolation from global markets? Some tried to bargain. Some tried to resist. Some tried to innovate. But recovery remained elusive. The 1980s in Latin America eventually became known as the lost decade. Growth stagnated. Inflation ravaged savings. Poverty increased dramatically. Meanwhile, the debt burden remained heavy because interest payments devoured national budgets year after year. Even when countries managed to avoid outright default, they found themselves trapped, unable to grow fast enough to escape the cycle. Economists debated causes, politicians blamed predecessors, and lenders issued warnings. But beneath the debates, one truth stood out. The global financial system had created incentives for reckless borrowing and reckless lending, and everyone was now paying the price. Eventually, new initiatives like the Baker Plan and the later Brady Plan attempted to restructure the debt, extend maturities, and provide partial relief. These were important steps, but they came late and did not erase the damage already done. By the time the crisis eased, entire generations had lived through hardship. Industries had shrunk, and trust in economic institutions had eroded. But the most unsettling part of this story is how familiar it sounds today. Decades later, global debt has reached unprecedented levels. Central banks around the world have once again kept interest rates low for long stretches, encouraging massive borrowing. Private and public debts in many countries have climbed to historic highs. Financial markets, once again, behave as if risk has vanished. Investors chase yield. Governments assume growth will continue forever. And just like before, the world is one sharp shift in interest rates, away from financial turmoil. Consider this. Global debt today is more than triple the size of the entire world economy. Corporate debt, household debt, and government debt are all at or near record levels. Many emerging markets carry external debt loads, reminiscent of the patterns seen before the Latin American crisis. And when central banks tighten policy, the cost of servicing these debts rises rapidly, echoing the shock of the early 1980s. The pattern is the same. Booms built on cheap credit, overconfidence during good times, vulnerability when conditions change. Looking at these parallels, one cannot help but wonder whether we have truly learned the lessons of history, or whether we are simply repeating them under different names and in different regions. The Latin American debt crisis was not just a story of interest rates, or oil prices, or development strategies. It was a story of human behavior. Optimism turned into excess. Excess turned into fragility. Fragility turned into collapse. And it is a story that continues to repeat. whenever nations forget how quickly the financial environment can shift. As we step back from this narrative, there are three important takeaways. First, debt is not inherently dangerous, but unchecked borrowing without long-term productivity gains is a trap waiting to spring. Second, global financial cycles are powerful forces, and relying on permanently low interest rates is an illusion that has broken economies before and likely will again. Third, crises rarely begin with a dramatic event. They begin quietly, with small choices, delayed reforms, and the belief that tomorrow will always look like today. The warning is simple. The world is once again filled with soaring debts, rising vulnerabilities, and governments betting their futures on stable conditions that may not last. History does not repeat word for word, but it often rhymes, and the story of Latin America in the late 20th century is one of the clearest reminders that what feels safe can become dangerous very quickly. If you found this deep dive into financial history valuable, consider subscribing for more stories that uncover the hidden forces shaping our world. Share this video with someone who loves understanding how the past keeps returning in unexpected ways. And let me know in the comments which financial crisis you want us to explore next. The more we understand these patterns, the better prepared we are for whatever comes next.